On Tuesday, July 13th, inflation in the US jumped to 5.4% in annual rate. This is a very high level, because we have to go back to the energy crisis of 2008 to find a higher level. As a reminder, in 2008, oil had risen to $173 just before the onset of the Great Financial Crisis in September with the bankruptcy of the Lehman Brothers bank. So, of course, today the price of oil is only $75 a barrel. Meanwhile, while inflation seems to be on the rise, interest rates remain stuck at the bottom. In general, the usual recipe for calming inflation is a rise in interest rates. So, what's going on? What if I told you that a rise in interest rates would cause the exchange rate to fall for both the dollar and the euro? Many of you have asked me what the mechanics of such a phenomenon would be. So, here we go. A bit of history. The last major inflationary shock took place in the 1970s, and it was essentially the governor of the U.S. Central Bank, Paul Volcker, who put an end to this inflationary cycle. To summarize the story quite simply, the inflation of the 1970s was due to two major triggers: the end of the gold convertibility of the dollar, which threw a lot of uncertainty on the international monetary system, and the two oil crises. What is complicated with inflation is that it is a phenomenon that functions with critical points, thresholds that trigger runaway inflation. In other words, once an inflationary cycle has taken root, it is self-sustaining until all artificially constructed economic balances are purged. Yes, inflation destroys false values to bring a government's expenditures down to what it actually earns. There can be no inflation in a well-run country with real and free market prices. Inflation is a regulatory mechanism, just as a fever is for a human being. In the 1970s, in order to restore confidence in the dollar and to stop this inflationary spiral, Paul Volcker deliberately and very strongly increased interest rates from 11% to 20%. What happened? It's a monetary phenomenon, and as Paul Volcker used to say, it's too much money chasing too few goods. In other words, there is inflation when the mass of money in circulation grows faster than the production of goods and services. By raising interest rates, the central bank has hit the heart of the money creation process: credit. As a reminder, in our current system, it is the commercial banks that create the money through the credits they grant the companies and individuals. In an inflationary period, it is in your interest to borrow to buy goods today because you know that tomorrow what you bought yesterday will be worth more. So it is inflation that will pay back your loan, not your work. So, by suddenly raising rates from 11% to 20%, the Fed broke this inflationary spiral because these rates were too high for companies and individuals. Basically, before Volcker, interest rates were lagging behind inflation, and by pushing rates violently and suddenly to 20%, the US Central Bank succeeded in reversing the trend by giving interest rates a lead over inflation. The problem is that by doing this, you also prevent companies and individuals who have sound projects to finance. So the Volcker policy has acted like chemotherapy. Raising rates so high is a poison that you send into the economy, but you hope that inflation will be defeated by the poison before it's your economy that doesn't recover. So the cure had the chance of killing the patients, and that's why the US went through a very hard economic recession at the time. This was the price to pay for trying to beat the disease of inflation. Jimmy Carter, President of the United States from 1977 to 1981, declared after Paul Volcker's death that his decision was politically costly, but that it was the right thing to do. Well, if we summarize things, the US deficits and oil crises have created too much currency on US soil, and to purge this false value, an economic recession has been necessary to reduce money creation. It remained from that time that the solution against inflation was to raise interest rates. What about today? Could we raise interest rates to fight against an inflation that would come and settle in our country? This raises two questions. The first, what is the nature of this inflation? Or in other words, what is the extent of the cancer? The second, would a shock on the interest rates be a medicine that the patient could bear? If not, how can we do it? So where does inflation come from today? There is one factor that everyone knows: the rise in oil prices. This is called imported inflation. Even if oil prices are not stratospheric, the progression is very strong because oil was worth $20 in March 2020, and a full year later it is worth $80. Over 1 year, it has multiplied by 4. As the economy works mostly in terms of dynamics rather than levels, this is a lot. At this point, you will tell me, yes, but the $20 oil was an anomaly of the anti-COVID crisis. It was a one-time factor and not a structural one, except that we have known for years with the policies to fight global warming and the anti-COVID measures crisis that the energy sector has largely underinvested in new deposits. The maximum possible production of gas and oil has therefore probably passed its peak, the famous peak oil. According to some, peak oil would have been reached at the end of 2018. In this case, oil prices will continue to rise relentlessly and act as a harbinger of the next recession when the economy can no longer support it. As for imported inflation, we may well be in a situation comparable to 2008. Then, the second source of inflation is the shortage that accompanies the rise in the price of raw materials. I see two major causes of this today. The first is the recovery of China, which absorbs a lot of raw materials, and the crisis of the anti-COVID measures, but not in the way that they are presented to us. On one hand, China is trying to control market prices in order to have access to the raw materials it needs. On the other hand, in the West, because of social support policies, factories are not really starting up again. Many sectors are looking to employ, but are short of people, while the number of unemployed people remains at an all-time high. I attribute this paradoxical situation to what the Americans call modern monetary theory and what we in Europe call universal income. The basic reasoning is the same. If you give money to the population without compensation, they will spontaneously start working. Money comes before work, or reward comes before effort, would be the new credo of Westerners. According to this diagnosis, we are eminently well on our way to a great inflationary cycle. Personally, I am not sure that this will work, and I think that the trillions of euros and dollars injected into the system in all its forms are a cause of inflation in the long run, because there is mathematically always too much money chasing too few goods, to quote Paul Volcker. Well, now that we have a theory on the nature of inflation, can we think of fighting it by raising interest rates? In my opinion, and this is just a forecast, the short answer is no. Here's the reasoning. If you raise interest rates, the finances of the United States and many European countries explode like fireworks because their debt becomes unpayable. They will have to default in one way or another, either by paying back in monkey money or by announcing an official destruction of popular savings, or by any other default mechanism that ultimately amounts in impoverishing the country. But that's not all. If you raise rates, you also blow up about half of the private companies in Europe that are essentially holding on to low rates and subsidies. In the US, I have not found any studies, but it must not be much better. So, a rise in interest rates is not possible because the patient is too weakened to start his shock therapy. But what can happen then? As the economy always regulates itself in one way or another, the most likely outcome is that the US and the EU continue to inject money massively until they die, because they cannot do anything else. In this case, it is the exchange rates that will have to go down. Okay, but in relation to what? Well, in relation to Asia mainly, since Asia is the last continent with good financial stability that is big enough to serve as a gauge against the US and the European Union. The fall in the value of the currency will also be seen in relation to the price of gold, real estate, and perhaps also in relation to Bitcoin. As far as Bitcoin is concerned, the question is more uncertain, and this will tell us a lot about where Bitcoin stands as an asset. If Bitcoin rises in due proportion to the fall in the value of the currency, then it will prove that it is indeed a store of value. On the other hand, if it continues its cycles of strong rises and falls, then it means it is still a growing, but not yet mature asset. As for gold, it should continue its progression in due proportion to the monetary destruction, as it has always done for 5,000 years. So it still has a strategic place in my portfolio. Finally, as far as real estate is concerned, the question is more complex because real estate is a clay pigeon for the taxman's rifle. Not movable, yes, real estate will retain some value, but remember one thing. If there is high inflation, you can't leave to be taxed elsewhere. You will pay a capital gains tax, which will be nothing more than a tax on inflation and therefore a tax on your assets. In addition, rental income remains easily taxable. Finally, in this scenario of the falling exchange rate, energy and raw materials in particular are destined to appreciate over the long term, and Western countries to become poorer in a scheme that has similarities with Greece or Lebanon for France if the euro explodes. Only those who render services to others for which we are willing to pay will get out of this situation. As the great philosopher said, "These times are like eggs. They are hard." However, this is the time to find solutions, because troubled times are also very favorable to change. So for the oldest among us, protect your heritage, and for the youngest, it is time to be creative and anti-fragile. On that note, see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.